They even said that this was more than 200,000 deeper than economists predicted, and it's worse than the 2008 crisis levels. This is why some experts have now begun to say that the Federal Reserve is too late to cut interest rates, and that a lot of this could have been prevented ahead of time had they eased their policies and cut rates sooner. On top of that, others believe that the Fed rate cuts now signal that 3% inflation is the new 2%, meaning they're never going to get prices to come back down to where they were before. Although in terms of lowering interest rates even further and potentially causing even more inflation, unfortunately there is one thing getting in the way, and that would be the 10-year Treasury. So here's what most people don't realize. The Federal Reserve is in charge of controlling and managing what's called the federal funds rate, which is basically the interest rate that banks pay other banks anytime they lend each other money. This is important because the federal funds rate impacts what's called the short-term Treasury yield. And yes, if that sounds confusing, think of it like this because it's very important. On a very broad level, the United States borrows its money by issuing what's called treasuries, which is basically a fancy word of saying it's an IOU that promises a certain rate of return over a certain period of time. In this case, when the Federal Reserve lowers the federal funds rate, like we just saw today, these short-term treasury yields don't need to pay you out as much money, and as a result they go down.